past 5 trading days have seen huge swings in the US bond markets on fears that the Fed will tone down rate hikes due to the bank collapses. The US two-year bond yields fell by over 100 basis points in 3 days for the first time since 1987. But now with the banking crisis appearing to wind down, attention will come back to the inflation numbers in US and in India. In both countries, the February CPI was actually slightly higher than market estimates. The US core CPI has actually risen 0.5% month on month versus market estimates of 0.4%. Also, India's February CPI was 6.44, higher than the CNBC-TV18 poll 6.29, definitely higher than RBI's estimates for Q4, which stand at 5.7%. So, will the central banks, both US and India, tone down their hikes? And yes, have we already seen the peak rates? Or will we see rate cuts in the second half? For all this, I have with me B Prasanna, Head Global Markets Group at ICICI Bank, and Mitul Kotecha, Senior EM Strategist at TD Securities. Gentlemen, thank you very much for joining me. Mitul, is the global fixed income fraternity, in fact, global financial markets, likely to move on as if the bank collapses are over, and now we are kind of in the pre-collapse mode?
Well, I think they will move on. I think the Fed and US Treasury, FDIC have done a pretty good job in providing a backstop for the US banking sector, certainly the regional banks, which, as you said, we had significant pressure on US banks in recent days, and we've had a bit of a bounce back overnight. But I think confidence in this backstop is growing. It does provide a very, very significant ability of banks to withstand the pressure and deposit withdrawals. But I don't think it's going to be a one-way bet. I think clearly it's going to be a bumpy road for markets in the weeks ahead. Still a lot of uncertainty. And as you said, we had such a big move in interest rate markets. The markets priced down the US terminal rate by around 100 basis points, at one point around 4.75%. And even this next FOMC meeting next week, we at one point had a 1 in 2 chance of the Fed hiking. Well, now it's gone up on the back of a firmer US inflation print. We think the Fed will move 25 basis points next week. But I think the Fed has to balance very finely between market uncertainty, risk aversion, and on the other side of that, the fact that we have got still elevated services inflation in the US.
Oh, absolutely. Those numbers were stark. Prasanna, what's your sense of the Fed rate hiking cycle? Has it mellowed because the Fed will bring in this input of financial instability?
Thank you, Lata. So, yeah, I think what the entire development of the last 3 days has done is rather than expecting the hikes to completely stop, what the recent episodes have done is, number one, it's clearly slowed down the pace of hikes that the Fed is likely to do from here on. Recall that there were fears of, Fed going to become much more aggressive because Powell himself made a statement prior to the episode post the labor data came out. So that is the first one. The second is it removed the fear of an ultra-aggressive Fed, which actually there were people talking even about the possibility of a 6% Fed rate. So that I think that fear is kind of got removed. And it is also, I would say, mellowed down the theory of, a higher for longer theory and brought in some amount of confidence that even if the Fed does go higher, they will have to go lower sooner or later, primarily on account of all the factors that Mitul also spoke about. They need to balance out things. And of course, the most important thing is the Fed has been, looking at labor market data and looking at spot inflation data. They were not looking at expected inflation data. Now, will this episode kind of, put them a thought that they should start looking at expected inflation, which is nothing but to say that the lagged effect of the monetary policy hikes that they have done so far, is it going to have a meaningful effect on labor data going forward, meaningful impact on inflation going forward, and hence slow down the rate hikes as we speak as of today. Okay. So I think that's the key nuance that we need to look at.
Okay, that's important. Probably 6% is out of the lingo. Mitul, your reaction to that. Do you think that kind of hawkishness, we may have to increase at a faster tick faster pace was what Powell said even in the Congress testimony. So do you think that 50 bips is out, 6% is out? What is your estimate of a possibility of a rate cut later in the year?
Well, I think, as you say, and I agree with the comments. I think it's now looking less likely that the Fed has to hike higher for longer. Banks now in the US are going to tighten lending standards. There's no doubt about it. It's becoming more difficult for banks to lend, and clearly, given what's happened, there's going to be risk aversion still in that environment. And so, if anything, tighter lending standards means that growth will probably weaken more quickly, and the Fed may not have to hike as aggressively and as long as the markets had previously priced in. I think a cut still seems unlikely near term in our view, and there was a few talking about the Fed even cutting at this month's meeting. I doubt that will happen, but I think what we have taken off the table is a 50 basis point hike.
Okay.
25 now seems the most likely outcome. And in terms of the terminal rate, I think 5.5, 5.75 still seems appropriate. But again, that will depend on how quickly inflation can come lower and wage pressures will ease.
Oh, absolutely. The jobs data indicated that the labour market is still in fine fettle, even if the hourly wages came in line with expectations. Prasanna, now let's veer back to India. Our CPI number was actually a little worse than expected. Our poll was clearly at 6.3 and it came in at 6.44. And the Reserve Bank is sitting at 5.7 for this quarter. I think we are going to end at least 6.2. So where does this leave the Reserve Bank?
So I think, Lata, clearly uncertainty has come in, primarily due to the uncertainty relating to the Fed and also the uncertainty relating to the extent of the growth slowdown that will now happen in the global economy as well as in India. So I think it's very clear that there are more cases that you can make for a wait and watch kind of a situation. And especially if you recall, the external members have already dissented. They have voted 4-2 in favor of the hike earlier. And so I think that is, the thing. But then recall that before the SVB episode, the market was actually even pricing in a 7% repo because we had actually seen a couple of data points which had come really aggressive, especially on the inflation side. So market was actually going ahead with 100% probability of a rate hike in March, followed by maybe a rate hike, even one more policy later. But I think what I feel RBI should do right now, irrespective of actually what the Fed does, while, by the way, we do expect the Fed to hike 25 basis points in March, there is still a high non-zero possibility of them not doing that hike as well. But what I feel RBI should do is to, I think, go ahead with the hike of 25 basis points, irrespective of whether the Fed hikes in March or not. And that is premised on the fact that in order to keep the interest rate differential between the two economies at a healthy level, this is a great opportunity because in the past 1 year, the Fed has been far more aggressive, and RBI, there was no need for RBI to be very aggressive from domestic factors, but it has its own repercussion on external factors. It has its repercussion. The narrow interest rate differential has its expression on the forward premium and hence the kind of actions that exporters and importers do. So I think from all this perspective, I do feel that the RBI should hike. Whether they will hike or not is, of course, a $1 million question, but we'll have to wait and see for that.
Okay, well, let me also get your rupee view before I go to Mitul. The current account for January was actually a surplus. I was hoping that before this conversation, I will get the February number. But nevertheless, rupee is on a strong wicket in terms of current account, but on a terrible situation as far as balance of payments bridging because of the big FPI outflows we are seeing. So your take on the rupee itself, is it like really out of hot water?
Okay, yeah. So relatively speaking, it's definitely out of the kind of concerns that we all had on the rupee maybe a month ago or 2 months ago. And the primary reason for the surprise is, like you rightly pointed out, the kind of numbers that we are getting on the current account, especially on things like remittances and services exports, we are really being pleasantly surprised on the upside. And the January current account deficit was actually a surplus, like you said. So I think that from that perspective, rupee, from a CAD perspective, for example, for FY24, we expect the CAD to be less than 2% of GDP. And even for FY23, we are far lower than what the initial naysayers were talking about. So I think from that perspective, it's good. What also you need to add on to the fact is that the lower rate hike trajectory, which is what the SVB episode has done, very clearly the dollar is not, the Fed rate is not going to 6%, means that the short-term rates in USD is not going to go as high as what was earlier expected, means that there will be a marginal dollar weakness against G7 currencies and against EM currencies as well. So these are the two positives for INR. But like you rightly said, on the capital account side, while we are seeing FDI flows trickling in, we are seeing the odd company raising capital surplus and bringing it into India. We are not seeing FPI inflows as yet. So from that perspective, I would say that it's kind of even. While I think this quarter you can assume that it's positive for the rupee, but I think the view on the rupee will turn for the positive definitely only if the view on equity markets and view on FPI flows also changes as we go into next year.
Okay, that's still in dibbly-dobbly state. And there's just some news coming in that Sweden's largest pension fund, Electa, invested in Silicon Valley Bank and in Signature Bank. So I think we've not heard the end of this story. Mitul, a final question to you. Do you see foreign funds buying Indian bonds if there is this kind of confidence in the rupee and a feeling that we are toppish on the rate hiking cycle?
Well, I think there's definitely foreign interest in buying Indian assets. I did a tour of Europe, UK, and India came up many times. And before that, we did an investor trip in India, and clearly clients are pretty positive about the outlook for India. It's still seen as one of the strongest growing economies, and the market-friendly measures are welcoming for investors. But that said, in terms of FPI flows, I think there's still reluctance to jump into the bond market. Clearly, with inflation still remaining relatively elevated in India, there is question marks still about how much the RBI hike. We would expect to see another hike, 25 basis points at the April meeting from the RBI. But there is a bit of reluctance here. And one of the questions also that comes up for foreign investors is the bond index inclusion. And there doesn't seem to be a huge rush for India to enter bond indices. And that is something also that perhaps keeps investors a little bit more reluctant. While on the equity side, it's a different story. We had very strong foreign inflows last year. I think this year will really depend on the broader global equity outlook, and especially whether this trend of risk aversion we've seen recently continues in the weeks ahead. But look, if we are near the top of the rate cycle, and if inflation is also going to start peaking out soon, then I think that bodes well for flows back into Indian markets. I think it may be a bit early yet, though, given that inflation is coming above expected, and the RBI still perhaps has to hike more to get on top of the inflation issue.
Okay, so that is yet another reason why the Reserve Bank may have to hike. But just an important point, I spoke to several former central bankers in India, and their expectation, you said, Prasanna, that there is a non-zero possibility of no rate hike at all by the Fed. Their reply was the Fed will just not do that, because that will mean buckling down, saying that I'm allowing the financial markets to arm twist me, and the central bank will not want to be seen. It's just an input I got, and I thought I should share it with you and the viewers. Mitul, Prasanna, thank you very much for joining me in this discussion. That's what's expected from the central banks and the bond markets. Thanks for watching. Trading Ideas will come up for you on Chartbusters in just a minute.